You know that moment when you're scrolling through Zillow at 2 in the morning, looking at houses you'll never be able to afford, wondering if the universe is playing some sort of cosmic joke on you. Yeah, we've all been there. You see a decent 3-bedroom house listed for $500,000 and think to yourself, how hard could it be? Then you plug your salary into one of those mortgage calculators and suddenly reality hits you like a freight train carrying student loan debt. I spend way too much time thinking about money and why most people seem to be perpetually confused about what they can actually afford. If you've ever wondered whether you're financially ready to stop throwing money at a landlord every month, or if you're just daydreaming about homeownership while eating ramen noodles for the third night in a row, make sure to hit that subscribe button and give this video a thumbs up if it ends up saving you from making a terrible financial decision. Here's the thing that nobody wants to tell you about buying a house in 2025. The old rules don't really work anymore. Your parents probably bought their first home when mortgage rates were reasonable. Houses didn't cost more than a small country's GDP, and a college degree didn't require you to sign away your life to pay for it. Those days are gone, my friends. We're living in a completely different financial reality. And if you're still using outdated guidelines to figure out what you can afford, you're setting yourself up for disappointment or worse, financial disaster. Most people think determining how much house they can afford is simple math. Take your income, multiply it by some magic number you found on the internet, and then boom, there's your budget. But that's like trying to navigate through a maze while blindfolded and expecting to find the exit on your first try. The real answer is way more complicated and frankly way more depressing than most people realize. Before we dive into the numbers that might make you question all your life choices, let's talk about something that's often overlooked. There's a massive difference between what you can afford and what a bank will let you borrow. Banks are not your friends looking out for your best interests. They're businesses that make money by lending you money. And sometimes they're perfectly happy to give you enough rope to destroy your finances. Just because someone approved you for a $700,000 mortgage doesn't mean you should actually take it, especially if you enjoy luxuries like eating food and occasionally leaving your house. The traditional approach to figuring out housing affordability revolves around something called the 28% rule. This brilliant piece of financial wisdom suggests that you shouldn't spend more than 28% of your gross income on housing costs. Sounds reasonable, right? Well, here's where things get interesting. This rule was created back when people wore bell-bottoms unironically and thought the internet was just a fad. It doesn't account for the fact that everything else has gotten exponentially more expensive while wages have basically stayed the same. Think about it this way. When this rule was created, people didn't have $400 car payments, $200 phone bills, and student loan payments that rivaled the Galilei of small nations. They didn't have streaming services, gym memberships, and subscription boxes for everything from dog toys to Artisol beef jerky. The financial landscape has completely changed, but somehow we're still using guidelines from an era when gas costs 50 cents a gallon. And you could buy a house with a loose change found in your couch cushions. Let's get real about what housing actually costs in today's market. When you rent, your monthly payment is exactly that, your monthly payment. It's beautifully simple. You write a check, you get to live somewhere, and when something breaks, you call your landlord and make it their problem. But when you buy a house, oh boy, that's when the fun really begins. Your mortgage payment is just the appetizer in the expensive meal of home ownership. You've got property taxes, which seem to increase every year, like they're trying to win some sort of award for creativity. You've got homeowners insurance, which has apparently decided that everything is a catastrophic risk worthy of premium increases. You've got maintenance and repairs because houses are basically just really expensive things that are constantly trying to fall apart. And let's not forget about all the little extras that nobody mentions, like WA fees, landscaping, and the sudden realization that you need to buy a lawnmower because grass has the audacity to keep growing. The 1% rule suggests that you'll spend about 1% of your home's value every year on maintenance and repairs. So, if you buy a $500,000 house, congratulations. You just signed up to spend $5,000 annually fixing things you didn't even know could break. That's over $400 every month on top of your mortgage payment just to keep your investment from literally falling down around you. Here's where the math gets really fun. And by fun, I mean terrifying. Let's say you make $80,000 a year, which puts you right around the median household income in America. Under the 28% rule, you could spend about $1,800 a month on housing. Sounds doable, right? Well, in today's market, $1,800 a month might get you a mortgage on a house worth about $250,000, assuming you've got 20% down and can find a 7% interest rate. But wait, there's more. That $250,000 house, you need $50,000 just for the down payment. So, before you can even start making those $1,800 monthly payments, you need to have saved up enough money to buy a decent car. Except instead of driving it, you're giving it to someone else. So, they'll let you pay them $1,800 every month for the next 30 years. It's like paying admission to an amusement park where all the rides are broken and the cotton candy costs $40. And here's the kicker that really makes this whole situation feel like a practical joke. If you're making $80,000 a year, you probably can't actually afford the median-priced home in America, which costs over $400,000. Let me repeat that because it's important. The person earning the median income cannot afford the median-priced home. It's like showing up to a restaurant where the average meal costs more than your weekly paycheck. This is where a lot of people start getting creative with their financial planning. And by creative, I mean potentially catastrophic. They start looking at interest-only loans, adjustable-rate mortgages, or putting down less than 20% to make the numbers work. Yeah, these strategies can work out fine if everything goes perfectly in your life forever. But they can also turn into financial disasters faster than you can say underwater mortgage. The reality is that figuring out what you can actually afford requires looking at your entire financial picture, not just your income. You need to consider your other debts, your monthly expenses, your emergency fund, and your long-term financial goals. You also need to be honest about your lifestyle and whether you're willing to live like a hermit for the next decade just to make your mortgage payments. Most financial experts recommend having at least 6 months of expenses saved as an emergency fund before you even think about buying a house. But here's the catch. After you buy a house, your monthly expenses are going to be higher, which means you need a bigger emergency fund. It's like trying to climb a mountain where the peak keeps getting higher every time you think you're making progress. The debt-to-income ratio is another crucial factor that lenders use to determine how much they're willing to lend you. Most lenders want your total monthly debt payments, including your proposed mortgage, to be no more than 45% of your gross monthly income. This might sound generous until you factor in student loans, car payments, credit card debt, and that gym membership you never use, but somehow can't bring yourself to cancel. Let's talk about what happens when you actually sit down with a mortgage lender. Because this experience is like going to a car dealership, except instead of trying to sell you undercoating, they're trying to convince you that borrowing $500,000 is a totally reasonable life decision. First, they're going to pull your credit score, which is basically a 3-digit number that determines whether you get to live in a house or continue renting that apartment where your neighbor apparently practices interpretive dance at 3 o'clock in the morning. Your credit score affects everything about your mortgage, from the interest rate to whether the lender will even look at you without laughing. A difference of just 50 points on your credit score can mean the difference between a 6% interest rate and a 7% interest rate, which over 30 years translates to tens of thousands of dollars. It's like the universe's way of punishing you for that time. Like you forgot to pay your credit card bill because you were binge watching Netflix. Here's something that might surprise you about the lending process. Banks have become surprisingly generous with how much money they'll let you borrow, which should probably be more concerning than comforting. Many lenders will approve you for a mortgage where your total monthly debt payments equal 45% of your gross income. Notice I said gross income, not take-home pay. After taxes, insurance, and retirement contributions, you might only see 70% of that gross income, which means your housing costs could easily eat up more than half of what you actually bring home. Let me paint you a picture of what this looks like in practice. Say you make $10,000 a month before taxes. A lender might approve you for monthly debt payments totaling $4,500. Sounds manageable until you realize that after taxes and deductions, you're probably taking home around $7,000. Suddenly that $4,500 in debt payments represents almost 2/3 of your actual spending money. That leaves you with $1,500 for food, gas, utilities, entertainment, and everything else that makes life worth living. Hope you like ramen noodles because you're about to become very familiar with them. The down payment requirement adds another layer of complexity to this financial puzzle. Most lenders prefer a 20% down payment, which gets you better interest rates and helps you avoid private mortgage insurance. But 20% of a $500,000 house is $100,000, which is more money than most people see in their bank account at any given time. Saving up $100,000 while paying rent, student loans, and trying to maintain some semblance of a social life is like trying to fill a bathtub with a teaspoon while someone else is pulling the drain plug. This is where people start getting creative with their down payment strategies. And creativity in real estate financing is usually code for potentially terrible idea. You can put down as little as 3% on some loans, which sounds great until you realize you're immediately underwater on your mortgage the moment you sign the papers. You owe more than the house is worth before you've even moved in your furniture. It's like buying a car that depreciates the moment you drive it off the lot. Except this car costs $500,000 and you can't return it if you change your mind. Then there's the wonderful world of closing costs, which is the real estate industry's way of reminding you that buying a house involves paying a bunch of people you've never met for services you don't fully understand. Closing costs typically run between 2 and 5% of the home's purchase price. So on that $500,000 house, you're looking at another $10,000 to $25,000 in fees. It's like a cover charge for the privilege of taking on a massive amount of debt. Let's talk about property taxes, because these are the gift that keeps on giving whether you want them to or not. Property taxes are based on the assessed value of your home and can range anywhere from 0.5% to over 2% annually depending on where you live. On a $500,000 home, you could be looking at anywhere from $2,500 to $10,000 per year in property taxes alone. That's potentially over $800 per month just for the privilege of owning property in a particular geographic location. It's like paying rent to the government for land you supposedly own. Insurance is another delightful ongoing expense that seems to increase every year regardless of whether anything bad actually happens to your house. Homeowners insurance can easily run $1,500 to $3,000 annually depending on your location and how much the insurance companies think your area is likely to be destroyed by various acts of nature or human stupidity. And if you live in a flood zone, earthquake area, or anywhere that hurricanes might visit, you get to buy additional specialized insurance policies because apparently regular homeowners insurance only covers very specific types of disasters. Here's where the math starts getting really interesting. Let's take that $80,000 annual income we talked about earlier and see what happens when we factor in all these additional costs. Under the 28% rule, you could afford about $1,800 monthly for housing. But when you add property taxes, insurance, and maintenance, that mortgage payment of maybe $1,400 quickly becomes over $2,000 in total monthly housing costs. Suddenly, you're spending closer to 35% of your gross income on housing, which doesn't leave much room for life's other financial obligations. The maintenance and repair costs are probably the most underestimated aspect of home ownership. Houses are basically giant expensive machines with thousands of moving parts, all of which are designed to break at the most inconvenient times possible. Your water heater will decide to die on the coldest day of the year. Your air conditioning will give up during the first heat wave of summer. Your roof will develop a leak during the biggest storm of the season. It's like Murphy's Law was specifically written about home ownership. The 1% rule suggests budgeting 1% of your home's value annually for maintenance and repairs. But that's probably optimistic unless you're handy enough to fix most things yourself. On a $500,000 home, that's $5,000 per year or over $400 monthly just to keep your investment from falling apart. And that's assuming nothing major goes wrong, like needing a new roof, HVAC system, or foundation repair. Any of which could easily cost $20,000 or more. Now, let's talk about the elephant in the room that nobody wants to acknowledge. In most markets across America right now, it's actually cheaper to rent than to buy. When you factor in all these additional costs, this goes against everything we've been told about building equity and the American dream. But the math doesn't lie. When you can rent a house for $3,000 a month or buy the same house for a total monthly cost of $4,000, including taxes, insurance, and maintenance, renting starts looking like the financially responsible choice. The equity argument that everyone loves to make about home ownership is also more complicated than it appears on the surface. During the first several years of a mortgage, most of your payment goes toward interest rather than principal. On a typical 30-year mortgage, you might only pay down a few hundred of principal each month initially. So, while yes, you are technically building equity, it's happening very slowly, and it's offset by all those additional costs that renters don't have to worry about. There's also the opportunity cost to consider. That $100,000 down payment could be invested in the stock market, where historically it might earn 7 to 10% annually. If you're paying 7% interest on your mortgage, you're essentially breaking even on the investment side while taking on significantly more risk and responsibility. It's like choosing to climb Mount Everest when you could achieve the same view from a helicopter. Here's the thing that really gets me about this whole situation. We're living in an era where a basic starter home costs more than what our parents paid for their dream house. Yet somehow we're supposed to use the same financial guidelines they used when bell-bottom jeans were considered fashionable and people thought the internet was just a phase. It's like trying to navigate modern traffic using a map from the horse and buggy era. The standard advice you'll hear from most financial experts is to follow something called the 33,030 rule, which sounds like it should involve basketball or some kind of drinking game. This rule suggests you shouldn't buy a home that costs more than 3 times your annual income. You should have at least 30% of the home's value saved up in cash. And your monthly housing costs shouldn't exceed 30% of your gross income. It's a neat little package that probably worked great when houses were reasonably priced and people didn't need advanced degrees to work at coffee shops. But here's where this gets really entertaining. If you make $75,000 a year, the 33,030 rule says you should buy a house that costs no more than $225,000. Good luck finding that unicorn in today's market. You'd have better odds of finding a parking spot at the mall on Black Friday. Or getting a straight answer from a politician during election season. In most decent neighborhoods, $225,000 might get you a nice shed or maybe a really fancy tent. The reality is that most people end up stretching these guidelines like yoga instructors on steroids. They convince themselves that spending 40 or even 50% of their income on housing is totally reasonable because they really want to stop living in an apartment where the walls are so thin they know their neighbor's Netflix password just from overhearing their conversations. Let me break down what actually happens when you push these boundaries. Say you make $100,000 a year, which sounds pretty decent until you realize that after taxes, you're probably taking home around $70,000. If you spend 50% of your gross income on housing, that's $5,000 monthly going to your mortgage, taxes, insurance, and maintenance. But remember, you're only taking home about $5,800 after taxes. Suddenly, that house payment is consuming almost your entire paycheck, leaving you with $800 for food, transportation, entertainment, and pretending you have a social life. So, there you have it. The brutal truth about what you can actually afford versus what your optimistic calculator dreams suggest. The math doesn't lie, even when we really want it to. Before you sign anything, remember that banks aren't your financial therapists. They're businesses that profit from your debt. Take their approval letters with a grain of salt the size of your future mortgage payment. If this video saved you from a financial disaster or just made you feel better about renting that apartment with the interpretive dance neighbor, hit that like button and subscribe for more reality checks that might crush your dreams, but save your bank account.